SentinelOne. They have a market cap of $5.5 billion. They're the smallest market cap that I'm looking at. And the revenue is 864 million. Net income, they're losing money, and they have a forward P of 69.88. Analysts think they could go up 49%. Again, they only look at earnings per share. They don't look at cash flows. Year to date, this stock is really sold off. Is it an opportunity? For the 1 year, down. For the 5 year, down. Oh, man. When we look at their revenue, they are the smallest revenue company I'm looking at. They're growing at 28%. That is very good. That is very good. But it's a small number. And I think CrowdStrike was mid 20s, and another one of the companies we looked at was mid 20s, but their revenue was much higher. When we look at the free cash flow, it's only 42.88. And whenever I've valued SentinelOne, I've had a hard time getting their valuation higher. It's a little bit like Cloudflare. How is this cash flow so low when you have a gross margin that's so high? Based on this cash flow, I would really have to be very generous to get them to a $2 billion valuation based on cash flow. And the current market cap is 5.5. So their lack of cash flow spoils the recipe for this stock being a stock that I would even consider. Cash flows are way too low. The forecast is really based on earnings per share. And some analysts have really high hopes for the stock with the price target of $33. And the worst case scenario is 17. Again, this is all based just on earnings per share. And the earnings per share are supposed to get into the profitable zone, but they're pretty low on profits. I mean, you have to use a pretty high PE to establish year one. This is the year that's going to end January 31st. So this is just a little too high hopes and not enough fundamental valuation for me to be an investor. I am out on SentinelOne. This is not a desirable company for me.